Welcome to my dear students. I am Mr. Ganeshan K, Assistant Professor of Commerce, Subject Corporate Accounting, topic Profit prior to incorporation. In our previous sessions, we have solved problems for profit prior to incorporation. In this session, no doubt we are solving problems for profit prior to incorporation, but we are preparing profit and loss account as per Companies Act 2013. Now, let me discuss this problem. Ganesh Limited was incorporated on 1/8/2014 to take over the business of Growing Limited as going concern from 1/4/2014. The following profit and loss account is given for the year ended 31st March 2015. Profit and loss account for the year ended 31st March 2015 to rent and taxes 12,000, to insurance 3,000, to electricity charges 2,500, to salaries 36,000, to directors fees 6,000, to auditors fees 1,500, to commission 10,000, to advertisement 4,000, to discount 2,000, to office expenses 7,000, to carriage 4,000, to bank charges 1,000, to preliminary expenses 5,000, to bad debts 2,000, to interest on loan 5,000, to net profit 49,000, by gross profit 1,50,000, total 1,50,000, 1,50,000. Sales up to 1/8/2014 was rupees 3 lakh and sales from 1/9/2014 to 31st March 2015 was rupees 7 lakh, ascertain the profits prior to incorporation as well as post incorporation period. Now, before solving this problem, let me calculate time ratio. So, time ratio is concerned. Now, our first job is to know the date of acquisition of business, right? Ganesh Limited was incorporated on 1/8/2014 to take over the business of Growing Limited as going concern from 1/4/2014. It means business was acquired on 1/4/2014 and it has been incorporated on 1/8/2014. So, from 1/4/2014 to 31/7/2014, so 4, 5, 6, 7, 4 months, it will be pre-incorporation period. Similarly, from 1/8/2014 to 31st March 2015, 8 months, so 4:8. Time ratio will be 1:2. I repeat once again, the business was acquired on 1/4/2014 but has been incorporated on 1/8/2014. From 1/4/2014 to 1/8/2014, it will be pre-incorporation period. From 1/8/2014 to 31st March 2015, it will be post-incorporation period. I mean to say pre-incorporation period in terms of month 4 and post-incorporation period in terms of months 8. 4:8. Time ratio is equal to 1:2. Calculation of sales ratio, second step, right? Now, let us concentrate in this additional information. Sales up to 1/8/2014 was rupees 3 lakh and sales from 1/9/2014 to 31st March 2015 was rupees 7 lakh. It means pre-incorporation sales will be 3 lakh, post-incorporation sales will be 7 lakh. So, sales ratio will be 3:7. In this problem, there is no need to calculate weighted ratio because there is no change in what? Employee salary, or I can say what? There is no change in the number of what? Employees. So, from the point of view of preparation of what? Profit and loss account, in terms of profit prior to incorporation, right now we have two types of ratios. One is time ratio, which is known 1:2, sales ratio 3:7. Now, let me solve this problem, okay, based on the available what? Information. So, gross profit, please concentrate here. What's the gross profit given? You tell me just now. 1,50,000. So, gross profit given is 1,50,000. So, sales ratio is 3:7. This 1,50,000 has to be apportioned the ratio of 3:7. 1,50,000 into 3/10. 45,000, remaining will be 1,05,000. Okay, gross profit has to be apportioned based on sales ratio. Now, what about the other things, right? Number one, rent and taxes. insurance, rent and taxes, time ratio, insurance, time ratio, electricity charges, time ratio, salaries, time ratio, directors fees, post incorporation, auditors fees, post incorporation, commission, sales ratio, advertisement, sales ratio, discount, sales ratio, office expenses, sales ratio, carriage, sales ratio, bank charges, time ratio, preliminary expenses, post incorporation, bad debts, sales ratio, and then he has given us about once again interest on loan. So interest on loan is concerned, it is time ratio and net profit as usual 49,000. Now let me solve this problem as per the Companies Act 2013. Okay. Schedule note number 3, we come across employee benefit what? Expenses. Under employee benefit expenses, okay, we consider salaries. Okay, salaries based on what? Time ratio 1:2, 36,000, 12,000, 24,000. Then, under finance cost, we come across what? Interest on loan. Once again, based on time ratio 1:2, 5,000, 5,000 into 1 by 3, 1,667. Then 2 by 3, 3,333. Then, other expenses are concerned, we are having rent and what? Taxes, then insurance, then electricity, then directors fees, then auditors fees, then commission, then advertisement, then discount, later on office expenses, carriage, bank charges. Rent and taxes, time ratio, insurance, time ratio, electricity, time ratio, directors fees, post incorporation, auditors fees, post incorporation, commission, sales ratio, advertisement, sales ratio, discount, sales ratio, office expenses, time ratio, carriage, sales ratio, then bank charges, time ratio. Now, see, we have a portion. Okay, time ratio is concerned 1:2, 1:2, 1:2. Sales ratio is concerned 3:7, 3:7. Total amount is given. We are apportioning these amount based on 1:2. In case of time ratio, 3:7 in case of sales ratio. We have obtained the following figures. The same will be substituted. Revenue from operation, gross profit 45,000, then 1,05,000. So, gross profit for pre-incorporation period will be 45,000 and post-incorporation period will be 1,05,000. Other incomes will be nil. Then next one, cost of materials consumed. There is no cost of material consumed in this problem. Nil. Then employee benefit what? Expenses. We have, I can say what, salaries 12,000, 24,000. Then depreciation and amortization. There is no depreciation and amortization in this problem. Then finance cost is concerned. We have interest on what? Loan. Other expenses. So whatever the residual items we have, that will be classified under what? Other expenses. And finally, we get what? Profit. So profit is concerned, okay, the first column, whatever the profit we obtain, that will be transferred to capital reserve. So whatever the profit we obtain, the second column, that will be transferred to profit and loss account. So as per Companies Act 2015, right? Number 1, we must remember number 1, revenue from operation. Second one, other incomes. Okay, on the expenses side, we are having cost of material consumed. Second one, employee benefit expenses. Third one, depreciation and amortization. Fourth one, finance cost. Fifth one, other expenses. We get total expenses. Total revenue minus what? Total expenses. We are getting what? Net profit. So, now my dear students, we have understood how to solve problems. Okay, based on Companies Act 2013 while preparing profit and loss account. Thank you. Thank you one and all.